I came into the business, the way I learned trading bands was via this specific trading system. We used the Dow Jones Industrial Average. We plotted a 21-day moving average, and we shifted that moving average up by 4.5% and down by 4.5%. And then we calculated two indicators. The first indicator was a 21-day advanced decline oscillator, and the second indicator was a 21-day up-down volume oscillator. And we did it the easy way, right? They were just simply sums, 21-day sums of advances minus declines, and 21-day sums of up volume versus down volume. And all you do is, you'd cross out the old number, add in the new number, and you'd have the new value of the oscillator. So it was a very simple system, and it worked like a clock. The rules were very straightforward. A sell alert was you tag the upper band, and one of those indicators was negative. And a buy alert was the reverse. You tag the lower band, and one of those indicators was positive. And then, of course, as everything that I do works, we wait for the market to confirm, because with a sell alert, it's just an alert. It tells us that the conditions are there for a sell. Just like a buy alert, it's just an alert. It says the conditions have been met for a potential buy. But we want the market to confirm our opinion, right? Because our opinion is just our opinion, but market confirmation is a fact that you can act upon. So in all of my work, I always wait for confirmation from price. Right? The final, my joke is price, the final arbiter. Right? If you've watched Star Trek, you understand that's a Trekkie joke. So, but I wasn't really interested in timing the market as a whole. I mean, it was an interesting sort of thing, but we couldn't trade the market as a whole in those days, right? No index funds, no S&P futures, no options, no broad market exposure at all available. The only thing you could do was buy and sell a big mutual fund, right? That was the only way you could gain broad market exposure at that time. Well, actually, there were a few closed-end funds at that time, but there were very few. They were very illiquid, and they swung between big discounts and premiums. So it was a very tough game to play. So my real interest has always been in trading stocks. I'm an intermediate-term stock trader. I hate to call myself a trend follower or anything else like that, because I'm really not. But I'm a big believer in relative strength and owning what's working and not owning what's not working. So this is how we approach that with trading bands. We use the same 21-day moving average. We set the bands by eye. You set the bands by eye to contain about 90% of the data, right? You wanted that. And, it was really hard. You trace out the average on the piece of tissue paper, and you slide it up and you go, yeah, that looks about right. You slide it down, yeah, that looks about right. Yeah. And I'll explain why that was a problem. I assume some of you understand intuitively why that was a problem, but this was actually a big problem. And the indicator we used was 21-day intraday intensity. It was written by a guy by the name of David Bastian. This indicator has been renamed and reformed at least a dozen times in history, but the originator is David Bastian, and the original article appeared in the Investors Intelligence Encyclopedia of Stock Market Techniques. It's chapter 4. David Bastian was a really smart guy. Who was drafted in the Army, and he sat at Fort Dix doing nothing for a long time. And he sat there thinking, well, what? It's institutional traders that set prices, really. It's the big money that sets the prices. And how can I create an indicator to do that? And he did this, created this indicator, parsing the close in the range and relating it to volume. We call it intraday intensity. And that and Larry Williams' accumulation distribution, I think, are the two most useful volume indicators. So the problem with percent bands I've already hinted at is setting the width of the bands by eye. It's very labor intensive. It has to be redone for each issue that you want to track, and it has to be redone as market conditions change. You move into long-term consolidations, as we have been in the past year, you want one set of bands. You move in a big trending market, you want a different set of bands. That's all fine and dandy, but doing it this way allow emotions to enter the process. If you're bearish, you set the bands to present a bearish picture, and if you're bullish, you set the bands to present a bullish picture. It's unavoidable. You can't. You think, oh no, I draw them properly, right? It's not true. It's just not true. So the holy grail was adaptive trading bands. You wanted some way to have this work done for you, to have it all is done automatically. And my solution was to use volatility to set the width of the band, specifically the calculation used for standard deviation. It's called root mean squared deviation. You don't need to do the math or understand it that much. It's all done for you these days. I say it's the calculation used for standard deviation because the sample size is too small to rely on the normal rules of standard deviation. So we're not going to see 95% containment plus or minus 2 standard deviations. For those of you who remember their stats, you're just not going to see it. In reality, we see about 90%, maybe 88%, maybe 91%, but in that range. And that's because prices just aren't normally distributed. So the cheap shot of Bollinger Bands is that they're plus or minus 2 standard deviations. Well, not so much. They're plus and minus 2 times the root mean squared deviation. And it avoid that trap of, well, I measured it and I counted very carefully, and it's only 90% of the data is inside the bands. You got it. So Bollinger Bands are the moving average plus or minus 2 standard deviations. You've been given your caveat here. And even for Bollinger Bands, which are relatively complicated, still just 3 lines of Python. You can see there, it's just calculated perfectly. ChatGPT gets one thing wrong when it calculates Bollinger Bands. Way over on the right-hand side there, you see that little thing that says DDOF equals 0. That means that in the calculation for root mean squared deviation, the divisor is going to be n, not n minus 1. It's a statistical thing, but it needs to be in order for Bollinger Bands to be comparable from my machine to your machine to your machine to the other machine. Degrees of freedom is what DDOF means. Is set to 0, then you have the population standard deviation. When set to 1, you have the sample standard deviation. And Bollinger Bands use population standard deviation. So other popular trading bands, Keltner bands. Any of you compare Keltner bands and Bollinger Bands to find squeezes and bulges? A few of you, right? Great technique. The original idea came from Chester Keltner in a book called How to Make Money in Commodities, published in 1960. He did not describe trading bands, right? He didn't have any idea about it. He didn't care about them. The work in there was called the 10-day moving average rule, I think it was. It's a simple little 2 pages out of the book, but in the 1970s, some traders in Chicago said, oh, that's a great idea, we can use that to make trading bands, and they converted his simple little commodity trading system into a set of trading bands, and that became very, very popular over time. They use average range. Keltner used average range. Today we use average true range instead. And what they really look like is a set of Bollinger Bands that have taken a tranquilizer. Right? They're just less volatile Bollinger Bands, if you will. And many people, those two over there, are among them. Compare Bollinger Bands and Keltner Bands when Bollinger Bands are outside of the Keltner Bands. That's a bulge condition. You look for a trend to end. When they're inside the band, that's a squeeze condition, and you look for something to start up, for a trend to start up. So it's a neat way of combining 2 different ideas from 2 different times. And that's how you calculate Keltner bands, and a picture of what Keltner bands look like. So other popular bands, Richard Donchian, a very famous Chicago commodity trader, calculated the Donchian bands. They were used by the turtles. They're very simple: 21-day high, 21-day low. You heard him talk about 100-day high versus 50-day low. You can mismatch these to suit your purposes. It was the core technical tool that was taught to the turtles. Very, very popular in the commodity world, almost not used at all in the equity world. I don't know why that is. It's not that they're not useful in the equity world, but mostly futures traders, commodity traders use these bands.